I think Ray Dalio for the last 40 years has called for this bond vigilantes trade, which is like, you sell the dollar and you sell bonds at the same time and all that, and it's never happened. But now we are, I think, at a point where it's more reasonable to price that tail a little bit fatter, and the market isn't doing that. The market isn't doing that at all.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kaastrup Larsen.
Alfonso, welcome back to the podcast. Cem and I have been looking forward to it. How are you doing?
Buongiorno, everyone. Doing very well my side. Very happy to see you guys.
Have you fully recovered from Italy's early exit from the Euros?
Next question, please. That was painful.
Now,
yeah, that was painful.
Well, we're all in the same boat there. Anyways, at the moment, we are navigating a dangerous macro environment that differs significantly from historical norms. We have massive debts and weak public sector balance sheets, which restricts policy options and increase instability risk. We have growing wealth and income inequality, polarized and angry electorates rejecting traditional policies and going to extreme measures as seen just a few days ago. We have fragmentation in global blocs leading to economic and military multipolarity. We have intense great power competition in Central Europe, Eastern Europe, and the Middle East and Asia, and cost imposed by the energy transition and climate change. On top of that, we have disruptive technology advancements like AI. So it's fair to say there's quite a lot to talk about today. But Alf, since I had to pick one place to start off with, I noticed that in your current pinned tweet outlines the significant challenges facing the global economy, emphasizing the impact of rising interest rates, inflation, and geopolitical tensions. And you underscore the importance of central bank policies and their role in shaping market dynamics, urging investors to be cautious and strategic in navigating this complex environment. So could I kindly ask you to elaborate on the key points that you mentioned, particularly the impact of rising interest rates, inflation on the global economy?
Yeah, I would say the key point there is that the channel through which higher interest rates are supposed to slow the economy are not at work right now, or have been not at work at all in the United States specifically, but they have been at work in other economies. And I think that's what has put people a bit on the wrong foot. So how higher interest rates are supposed to slow an economy is very simple. You hike rates, you wait for a bit. A lot of households and corporates have to refinance their liabilities at higher interest rates, their mortgages, their corporate loans, what have you, and their debt servicing cost goes up. And as it goes up, it will eat a larger portion of their disposable income, their salaries, their earnings, whatever it is, and therefore they will need to slow down on spending, on hiring, on all activities which support economic growth. And as they do that, slowly but surely, the economy slows down, you create less jobs, and finally you slow down, potentially towards a recession. But anyway, the economy does slow down. So this time in the US, that pass-through of higher interest rates has been incredibly slow because corporates have locked their liabilities for 15 to 20 years, because households have locked their mortgages for 30 years. And so when you look at the pass-through, it's very slow. The amount of floating rate corporate loans and bonds in the United States is very, very low as a percentage of total. US corporates don't use loans and banking credit channels too much like in Europe, for example, but instead they use capital markets pretty aggressively, which means they can lock in their duration, and they did. They locked in duration for a long period of time. And the same goes for mortgages. You don't have a floating mortgage market in the US, really. It's all fixed, and people have locked for long. So that has meant that the pass-through so far has been pretty slow. And the other thing is, normally the level of private sector leverage is what causes issues at the economy level. If you look at the past, in Japan in the 1990s, Asian tiger crisis, late 90s, Spanish housing market or Irish housing market, 2012, 2013, China today, you might want to make a case for that. All of that are the result of excessive level of private, not government, private sector leverage, which then clash against the hiking cycle. It's always been the same story. But if you look at private sector leverage in the US today, it's not excessive by any standard. Looking at history, it has not gone up over the last 10 years. So this is not 2005, 2007, where it's private sector leverage that causes a concern, or debt pass-through that causes a concern. But the government instead is picking up the slack, right? It's all about deficit as a way of sustaining the economy and creating money. So this is a bit, I think, what people have been surprised and confused about. This cycle is quite interesting and quite strange. And now we move to the other side of it, where everybody says, well, guess what? There's not going to be a crisis. If it doesn't happen so far, it can't happen. And my last point before I shut up and let Cem talk for a second is, if you look at economies which are more vulnerable to higher interest rates, because they do have floating mortgages, they do have refinancing cliffs, they do have high level of private sector leverage, Sweden, New Zealand, they are showing fragilities. The central banks are cutting rates already. So there are ways and ways by which higher interest rates can impact the economy. For the US this time, it's a bit different.
I totally agree with that sentiment, and I think it's a very astute point. I think the other side of that, which I think is important to note, which I think you probably would agree with, but I would love to hear your thoughts, is what that means when we do actually start cutting rates here in the US. Because as I see it, there is a dramatic amount of pent-up demand, right? That people who are locked into homes, right, at lower interest rates that would like to move, or people who have been waiting to buy for pullback. So I think the Fed fund, I think we're much more sensitive to the Fed funds rate here in the U.S., or rates broadly, I guess I should say, not the Fed funds rate, but 10-year and mortgage rates here in the U.S. than we normally would be. But it's asymmetric. As they come down, I think it releases a lot of demand, but there's a dramatic lag in how much it slows down things on the upside. So it's a very different, people think about these things linearly, and I think it's important to realize that that's probably not the case.
Yeah, 100% agree. One caveat is that you're right, rates down the curve are important, especially 5 to 10 year, because generally speaking, corporate liabilities have 7 to 10 years duration. The mortgage market in the US specifically is very long dated. But in general, let's say the 10-year point of the curve is very important for the pass-through of monetary policy to the private sector. But the 10-year part of the curve is basically can be decomposed into what the Fed will be doing for the next 2 to 3 years. And that's what's already priced today in forward markets, in SOFR markets, in the futures, plus a term premium. So basically, what is the reward that investors want to be paid for? The uncertainty about the volatility of the macro cycle coming, because I can roll my T-bills for the next 10 years, every 3 months, right? If I want that exposure, I can get that, and I don't have any interest rate risk, or I can buy 10-year treasuries today. Then I lock in a certain rate for sure, but I also will be facing quite some vol, right? And the higher the vol, the more the term premium, the steeper the curve must be. And if you look at this decomposition today, well, 10-year rates are pricing effectively at zero term premium. So investors are saying, I don't want to be compensated for much risk. Note, the term premium was negative during QE years, etc. So we went to a point where people did everything and more to try and onboard duration risk, completely ignoring any potential macro vol risk down the road. Now we're back at zero. So that part can go up in principle. But when it comes to what the Fed is priced to do, I think after the latest rally, we're now seeing the Fed basically priced to cut every quarter pretty regularly for the next couple of years. So that 10-year rate will influence a lot of the pass-through, I think, through the US economy. But that dichotomy between keeping rates higher for longer slowly suffocates and tightens conditions for the private sector. But it does so pretty slowly because of the structure of the private sector in the US, as we described, While if you embark in a rapid cutting cycle, while nominal growth is still strong, well, the effect can be more vicious on the other side, right? You already see markets doing new highs and specifically certain assets. You see gold doing particularly well. And I know this is a point where you want to jump in, Cem, probably to talk about that. And well, the odds of the Trump election, I think we should cover that part too.
Absolutely. Yeah, I think it's been very interesting. We were talking offline briefly. There's been a lot of, I find it interesting. There's been so much talk about the, inflation break-evens and why they haven't responded in the last several years, right? It's been the trade that everybody was talking about. But now that we're starting to see, inflation come back down, that inflation narrative and the people looking at break-evens, people have kind of looked away from that trade and said, well, that's not happening. And I find it interesting, right, as people are doing that, right, which often happens, that we're actually under the hood starting to see a little action there, both in break-evens, gold's response, right, more recently, the steepener, the twos to tens are kind of starting to turn back up and technically look really interesting. Obviously, this dovetails into the Trump likely election here. But I'd love to hear your thoughts on that and also just broadly where you see the steepener, inflation expectations, et cetera.
Yeah. So I would say we have to talk about the Trump trade, I guess, which is something I've heard a lot lately. And how do you trade the increased odds of a Trump victory and specifically of a Republican sweep, which is even more important from a macro policy application perspective, right? If you have the president and the House and the Senate, then, well, your policies are most likely going to be applied. So what the market is doing, Cem, I think here they are taking their probability distribution of outcomes for the elections, and they're now saying, wait a second, I need to recalibrate that because after the events of last weekend, the odds that Trump's going to win are higher and the odds of a Republican sweep are also higher. So now we need to reprice a bunch of asset classes with a higher probability towards Trump's policies. Okay, so what are these policies and how do they work? Well, from his economic agenda, I think we can derive that he wants to do three things at least that will be important for markets. The first is restart the tariff engine a way or another. We don't know a lot of the specifics about it, but we know that tariffs tend to be stagflationary/inflationary on the margin. Before I walk through this, important, if Trump applies all of his policies, but from a global macro perspective, you are in a big disinflation, deleveraging environment, it won't matter. He won't be able to generate much of what he wants, but that's not the point. The point here is the market has to reprice some asset classes based on the increased odds of these policies being applied. With the current set of information, that's what the market will do. So if you look at these policies in isolation, well, tariffs tend to be net inflationary or stagflationary, I should say, in general. So you reduce the amount of trade growth, I would say, plus you increase prices in general, okay? So you do that, and then you have a tough stance on immigration. And net immigration in the US has been very strong so far, and it's been one of the reasons why the labor market has been so fantastically disinflationary, but keeping on pretty nice because the amount of labor supply has increased rapidly. It's not only a demand story, but the supply has made it so that wage growth remains contained, and therefore the whole thing looks amazingly disinflationary. Now Trump comes in and says, no way, this is not going to continue. So the flow of this cheap labor supply to the US kind of gets hampered. That's also inflationary on the margin. And then finally, the guy says, I want a weaker dollar. I want the Fed to cut rates. He can't engineer those things really, but he will put pressure on the Federal Reserve. There are even rumors that he might kick Powell out before his term expires. All these things anyway will contribute to the Trump trade. And the Trump trade, I think, is the steepener you were talking about, Cem, because how it works is the moment you start putting pressure on the Fed to be somehow more dovish on top of policies that are inflationary, on top of an economy that from a nominal growth perspective is already doing fine, well, what the market needs to do in bonds is put up some of that term premium, demand some compensation to buy these long bonds because you have a guy that is applying inflationary policies while forcing the central bank to be dovish. So guess what? I want some uncertainty compensation. I mean, what is inflation going to be in the future? Well, more volatile probably. So I want to get paid for it. And that gets into the long end of the curve. And so the curve does steepen. I think this is the Trump trade, the king one, I would say. So we're seeing that happen. there is a more technical part where on a podcast, it's easy to say I like a steepener. When you have to put it up, you have to pay negative carry and roll. So it's a trade you pay to be in, which means on a podcast, it's easy to say, if you're a macro trader, you have to check how much does it cost to hold this thing, over the next few months versus how much money do you plan to make on that. That's a different story. I think from a macro standpoint, steepeners are looking very good. The dollar instead, that's a separate topic. We can talk about it. I think gold, Bitcoin deserve attention as well as potential Trump trades as well. And we can chat about that too.
It scares me when you and I agree this much. It really does. Because we've had a lot of disagreements over the years, and that makes for a healthier probability of the trades working one way or the other. But I think you have completely highlighted the three-legged stool. It's the exact three things I would have highlighted, right? Tariffs are the obvious one, as you mentioned. Everybody knows about the tariffs. He's about as loud and boisterous. We've seen that before. That makes me a little more skeptical that he'll, that's one that makes me, I'm not as confident that we'll get the tariff response. You'll have the bluster, but I think that one might be different than people expect. I think it's the immigration policy, and you touched on it exactly. That is so important. And that's so different than what we've seen this time around. And it's the one that he has the least ability to not do. Since he was in office last time, that has become the rallying cry. It's the xenophobia we all know that come during these populist cycles that's happening here in the US as well. And it's visceral here if you're in the United States and if you're in a major city, which are a lot of these independent voters that are now kind of moving over. You have, through policies that were very smart on Republicans' ends, they bust a lot of these immigrants that are coming over the border into the cities in the northern across the U.S. Being here in Chicago, most of the homeless people now, we've dealt with a lot of the homeless policy for citizens here, and that part's gotten better. But what's happened is we have migrants on every corner now with their families, and that's a new thing. And that creates a very different psychology here in the U.S. So there's this real xenophobia that's developing. Immigration is the biggest topic, and it's actually more widespread than it has been historically. It's becoming a kind of a national phenomenon. So I do expect strong anti-immigration policy, and I think that is the key. It's been really the thing that's allowed labor to not, expect, inflation to stay at bay here relative in that labor piece, which I think could be a real problem.
But what's also interesting, actually, is his choice of vice president, which we know now since we're recording on Tuesday, because as far as I know, J.D. Vance has been incredibly tough and outspoken about China, saying China is the biggest risk that the U.S. face right now. So in that sense, you could say that maybe, I'm not disputing what you said about immigration, but actually I think the whole tariffs thing about adding 60% tariffs on China and 10% on everyone else, probably...
They're both important.
Exactly. They're both important right now.
Agreed. And that China policy everybody knows and is expecting, I guess, was my point. The immigration one is what many people are sleeping on. But I agree that the China in particular policy is
But that leads me to a question to both of you, because I'm not entirely sure, except I probably know where you stand on this, Cem, but I may have forgotten about your thoughts on this, Alf. I mean, I have heard some economists argue, and I'm not an expert, right? But that the inflation, because it comes down to inflation as you talked about earlier, but that the 70s were largely a cyclical inflation that resulted from policy errors, while the 40s was more a structural one that sort of in the aftermath of the Second World War. And now we have kind of a bit of both. And now we're throwing this, new regime potentially in the US into all of this, plus everything else that's going on right now. So the question is, what kind of inflation are we really dealing with here?
I'm going to tell you my answer, but I don't think this is particularly tradable in any forecastable time horizon. So it's just a pour parler, very interesting discussion. So far, Cem and I discussed about how the market should adjust the probability distribution given Trump's policies. Okay, and these policies are, we can discuss what's more important, tariffs or net immigration curve, but they're both stagflation or inflationary. So we think the market should react in a certain way. The next question should be how much is already priced in, but we can already discuss about it. And then it's positive carry, negative carry, all this framework type of discussions. Okay, cool. This one instead is a more theoretical one. Let's start from what the market is pricing here. The market is pricing that what we saw is basically a cyclical thing, that it's pretty much behind us. That's what the market is pricing, okay? The only thing where the market slightly differs, and it's touching a small structural probability that inflation will actually be higher, is the nominal neutral rate that the bond market is pricing. So if you look at 5-year forward Fed funds and you look like, well, let me see what the market, this is coming as a sort of a neutral rate 5 year down the road. Right now on my screen, 5-year forward Fed funds are priced at about 3.5% in nominal terms. Ask me back in 2019, how many people would say that the nominal neutral Fed fund rate at which the US economy runs smoothly is 3.5%, and I would tell you a small subset of the people. Most of them would have said 2, yeah, Cem, one of them, I know, 2, 2.5, and now the market's like, no, it's 3.5. Is it saying it's 5? No, but 3.5, so it's a touching some premium. This is the only indication, because if you look at, for example, long end vol being priced in bond markets, right? If you would expect a high structural inflation, what you would get in exchange is more vol price in the back end of the curve, right? Because it's got to be higher. You have a higher level of inflation, which means the Fed funds will need to be higher and then need to be cut faster and then hiked faster, etc. You don't have any of that priced. So that's what the market thinks. The market thinks like 80% cyclical behind us and 20% odds, roughly. Okay, that's going to be structural. Personally, I think it might be closer to 65-35 type of thingy. So I'm a little bit higher on the odds that I think we should reprice some of this risk premia towards, let's say, inflation risk premia a little bit higher. I think we have arguments to point to that. And there are trades you can park in your book and spend some premium and, leave them there, like the long end bond that I discussed. But I'm not sure it's a highly tradable topic of discussion. It's a nice one, but it's not going to make or lose money, I think, for listeners in the short run.
Two things that I think are interesting. So first of all, markets, as you know, Alf, can be incredibly illogical. To highlight my favorite example of this, 10-year vol in the S&P 500 in 2007 was 13.5 at its low, right before the crisis. In 2009, 2 years later, 10-year vol was 60% at its peak. Both of those outcomes are absolutely illogical. Everybody knows they're illogical, but they go there anyway. And they go there anyway as a function of structural dynamics of supply and demand. So I always caution people when they're looking particularly at long-dated things like that are liquid, to subscribe some type of logical, just because those expectations are there does not mean that's what's likely. I just want to put that out there. 2, Niels, you mentioned a policy error in the 60s and 70s. I would not classify that as a policy error. I think it's semantics. But the reason I wouldn't qualify it as a policy error is because I would argue that politicians didn't have a choice. There was a political dynamic in place, and politicians are vehicles for the most part. They cannot just go against the public's demands, at least in a democracy or a republic. They have to, these guys are, at the end of the day, marketers. I mean, I would argue Trump is a marketer, right? He has found a source of demand that people want, and he is selling it to them, right? That is why the immigration policy is likely to be what it is, as I mentioned, right? This is why the anti-China stuff has come about after all these years. And so in the 60s, there was this growing generational divide, right? There was a populist rhetoric and move, right? And eventually, ironically, we can get into the assassination and its effect with JFK's assassination led for a release of policy, which is what LBJ did. He took that sentiment and passed the Great Society program here in the United States. Some people will still point to the Great Society program and say it was an incredible piece of legislature or whatever, but it drove this it released this populist push. And that also led to protectionism and eventually a building Cold War and eventually a hot war in Vietnam. It led to protectionism, which led to an OPEC crisis. All of these things were connected with a structural dynamic. And we could argue that they're a mistake, and in a sense, they were a mistake. They did drive the inflation. But in my view, they were essentially inevitable in some form or another. Now, it may have been more extreme. They could have done things along the way that were maybe more economically thoughtful to make it less bad. But the structural inflation from that period was a function of the populism and the zeitgeist of that generation, the baby boomer generation that came to political dominance during that time. We are seeing the same thing happen. And so if we make the same mistakes again, is that a policy error? If at the end of the day, politicians don't really have a choice, right? That's the question. And now, I think what we need to account for is that Trump might now have enough of a mandate. He may have enough of a ability to go against some of these popular policies. Ironically, like it took Nixon, of all people, to open up China, right? I think people talk about that. Trump may have a mandate, enough of and may be perceived as populist enough to actually do things that are counterintuitively less populist. And I think that's something we need to be mindful of. I do think we're in a period much like the 60s and 70s. This is not we could argue because of COVID that some of these things were much like coming back from the war, initial inflationary impulses from COVID, which I think we well know. But I think more importantly is this millennial on down, structural populism and desire to reduce inequality. That's my view.
One thing I wanted to go back to actually in our conversation that I'm also interested is kind of how your view has changed in the last year, Alf. I remember a year ago you were pretty vocal about interest rates being slashed to 1% or below in 2024. That could still happen, of course. We don't know. But I sense a little bit of a changed view, a little bit. What could have caused you to believe that they would have to be so aggressive in that? And maybe what's changed in your view that actually, no, this is a bit different?
Well, I would say I am a macro investor, which means that I'm not paid to be right or wrong, which is a very strong statement. So macro investors are not paid to be right. They are paid to look at the set of pricing and then look at potential outcomes and say, what is that it's priced at the way that I would want to welcome in my portfolio, okay, at the right price, because the distribution might shift in the future. So at some point you went to price 10-year rates at 5% in 2023, okay? So to price 10-year rates at 5%, you have to make a lot of hawkish assumptions that this is going to, Fed funds have to be at 4% nominal neutral, 4%. And then you have to make a certain assumption about term premium being positive. And, it's quite a hawkish set of pricing. So when you look at that, you might say, okay, let's look at the tail. On the other side, how much do I pay now in order to onboard some of that? And of course, some of that also comes with the idea that sooner or later, the lags come in. They're slow to come in, but ultimately the pass-through needs to work out through the economy. So then you look at that, and then there are points where in, January 2024, there are 7 cuts priced for 2024. And it's the complete opposite set of pricing. So then you have to be pretty nimble, I would argue. Where I was wrong there was in early 2023 and late 2022, where I had completely overlooked the fact that the private sector in the US was structured very differently than 2006, 2007. And so the pass-through would have been slow. And then, of course, you position the portfolio more towards the odds of a recession, and then you're paying premium for nothing. And then you need to stop out and you need to reassess. But the reassessment has been, I think, a combination of looking a bit more deeper into the structure of the US economy, which is quite interesting this time. The fiscal boom of 2023, which has come on top of the fiscal of 2020, 2021, by the way. So Biden also came back pretty strong with fiscal again in 2023. So you need to put that into account. But ultimately, Niels, it's more about again, looking at a set of distribution and pricing and trying to look at where the distribution might be unreasonable. And sometimes it doesn't demand you to be terminally right on a macro hypothesis, although it sounds very fancy then on Twitter. If you were right on the hypothesis, then you're a hero. But in principle, that's not how it works. You just look at different set of distributions and you say, where can I onboard some tails or some part of distribution which are, I don't know, like, let's say, strangely priced, that people aren't paying attention to a certain topic or are willing to pay for that particular tail. That's, I think, the job of a macro investor. It's a bit different than the job of I would say, macro strategist or podcaster, but those are two different jobs, I would argue.
By the way, I forgot to say that regarding the Chinese and U.S. relationship, there was a little bit of good news, actually, which usually indicates that diplomacy is on a mend, and that is the fact that I saw that China has agreed to lend 2 pandas to the San Diego Zoo, which they don't do normally if there's any form of political trouble. Anyways, that's a little bit of a sideshow. Jim, you wanted to jump in there?
Is that a bearish comment? No,
yes, maybe.
Panda bears aren't actually bears, so I don't think we can. No, I think the reality is, I like this a little bit, Alf, because we can now disagree again. This is my favorite. So no, but I in the late 23, again, I think the way you were talking about, and part of our disagreement then was, again, partially because of how the curve was priced. But also I think broadly at the time, understandably, you were thinking, if I don't want to put words in your mouth, but about the cyclical realities, right? And I think what's come to light really, and what we were talking about then, which I think has broadly been true, and I think people are coming around to, is that this is not going to work like it's worked the last 20, 30 years, right? In the sense that this is not just about cyclical effects, right? Just because we're going into recession doesn't mean long-term rates are going to come down. And I think that is eye-opening to people. And I think part of why the curve has been incorrect and inefficient is because 30 to 40 years of data is a lot of data. The way models have worked for 30, 40 years has a lot of, mental memory, and that I think if this curve does steepen and break-evens do start to release and break out, I think that could really get a lot of people kind of offsides. I think people got a little bit offsides in 2004, right? Because they were playing that cyclical game. But now that the recession is coming, and it is coming, right? A slowdown, at least in the short term, is coming. How deep it will be, how meaningful it will be, whether it's just stagnation, we can argue. But I think the secular dynamic of inflation caused by not cyclical dynamics, not whether the economy is slowing or accelerating, but what's happening to things on the margin, meaning tariffs, immigration, just broad populism, and the rebalancing of wealth to different parties, I think is critical to this inflationary story. And that's what was true in the 60s and 70s. And that's what's true when interest rates broadly are structurally marching higher versus just a cyclical back and forth. I'd love to hear your thoughts about that, A, and B, if you agree with that or not, and also how you think about these cyclical effects now versus the bigger structural macro effects, which, by the way, the bigger structural macro effects literally almost didn't matter for 30, 40 years. Being a macro fund was a hard place to be for 30, 40 years. And that's changing. I think that's part of probably why you're launching a macro fund. We do a lot more macro than we used to, right? Because it matters more. Would love to hear your thoughts.
Yeah, we are relevant again, finally, after a couple of years of, realizes some people at 7 or 8 for a prolonged period of time and all about carry and very little to do. You were rewarded nicely for beta on a risk-adjusted basis. So it was a tough period, but now I think things are different. So now we go back to talk about the cycles versus the structural part, which is a very interesting discussion, I think. So on a cyclical perspective, I think that, as I said, the pass-through is low of higher interest rates, but it is happening. It's happening faster in other economies. We mentioned Sweden and New Zealand, which, by the way, those are topics that in a macro fund you can play. You can go currencies, you can go rates versus rates, and do different type of relative value expressions. I mean, macro investing is not, people think it's like punting on 10-year treasuries up or down. It's not necessarily that. It's a bunch of other things you can do which don't have beta attached to it, like relative value exposures between two different economies that have two different pass-through cycles, right? So the pass-through in the US is low, but it is happening. I think we see it. I mean, the labor market, from the demand perspective, it has been slowing down. And you can see that happening, right? And other signs, I think, were finally a bit of the pass-through is coming there. So what's going to happen then? If you play it in the bond market, then I think you're right in the fact that you should play it at the front end and not at the long end. Because normally during a cutting cycle, due to a slowdown in nominal growth, then, well, the curve steepens. It steepens because the Fed is up to cut faster than what forward markets are pricing in. And also because it supposedly, when the Fed cuts, it stimulates forward growth and forward inflation. And so the long end can incorporate some of that potential effect down the road. That's a normal stance. So you should already play it at the front end rather than at the long end. This time even more, I would argue, Jen, because of what we discussed before with Trump. His policies are a steepener, I would say, on the margin. And then because of the structural things where we might disagree whether it's a 35% odds or a 50% odd or whatever is the odds, but the odds are, we both agree there, funnily enough, the odds should be a bit higher than what the market is today pricing in, that structurally we need to assign a bit more inflation risk premium, a bit more term premium into market, and these all goes into long end volatility and, a steepener. Also, that part is a steepener of the curve, requires investors to demand higher yields at the long end. So then what happens is that you can get a recession and you can get a steepener that is even faster than the steepener you would expect during a recession, because not only you get the cyclical part of the steepening, but also some of the structural discussions that we are talking about now. And then finally, we go with the trade structuring. I mean, we talk about this thing and then people start looking at it. And when, by the way, Bloomberg just released a front page article talking about the steepener and the Trump trade. So that's generally tells you that we are probably 50-60% priced already. Okay, just a word of caution from my side. Then you look at this thing and my screen right now says that if you want to hold a 2-stance duration weighted steepener in your portfolio, so you buy the 2-year futures and you sell the 10-year future, and in the right size, so that it's the curve move that matters and nothing else. So you're matching the duration of the two contracts. And then you hold this thing. You basically have to pay about 20 basis points per quarter to hold the trade. So translating, the 2-stance curve is inverted at about minus 20 basis points, the time as we speak. If in October, so 3 months from now, the curve has gone to zero, so it has disinverted basically, okay, you have made no money. Because you've just paid 20 basis points of carry and roll to be in the trade. And so you see, like, can the curve go to plus 50? Sure, it can, but the hurdle that you face because of the negative carry and roll is not something that you can overlook easily. So then you have to think a bit smarter, like, okay, how do I do this? Can I use some options where I will have to pay premium, but maybe that's, let's have a look at that as a way to express the idea. Can I do it in vol space, or can I look at other asset classes that also benefit from a Trump election? And in my opinion, we discussed gold, but also Bitcoin is an interesting case in point here, at least in the short run, for a couple of reasons. I mean, you have the correlations between Bitcoin, gold, and Nasdaq, and caveat. Bitcoin as a macro asset class, I think, is well explained by a regression of two variables plus some residual. The two variables are gold and Bitcoin. Gold and the Nasdaq. And then the third variable is, of course, some residual. You can't fully explain to be only two variables, but gold and the Nasdaq explain a lot of the Bitcoin price action as a macro asset class, that is, right? Occasionally you will find a Mt. Gox price or some liquidation, some very idiosyncratic crypto event, but as a macro asset class. The idea of having a gold at a higher beta, a gold with tech features. So basically, gold and the Nasdaq mixed together works very well to explain, generally speaking, the beta of Bitcoin. Now, if you regress today the short-term performance of Bitcoin versus gold and versus the Nasdaq, you'll find, well, first, an underperformance of Bitcoin. Second, correlations that are going to zero or negative, which when it happens in the past, it has to do with some short-lived idiosyncratic events. Like today, we can say Mt. Gox or whatever it is the event. generally, these correlations tend to mean revert to their positive levels. And if you look at that, you should assume Bitcoin might have some ground to catch up. But importantly, like gold, it is an asset that can do well under Trump because, again, if you apply inflationary policies while you force or you pressure the Fed to be dovish, the market will look for release valves for this macro theme, right? So what is a release valve? Well, gold, right? Because what you're doing is you are artificially devaluing your currency. You are effectively forcing the central bank to be dovish while you apply inflationary policies. That's like emerging market playbook number one to devalue your currency pretty much. And so what happens is that assets that are priced in that currency and that tend to be a bit disconnected from this financial system tend to do particularly well. So gold is clearly the king expression of that. But hey, Bitcoin can do pretty well in that environment too. So what about upside optionality on Bitcoin? Can that be an idea? Yeah, you go and look into these options and you see that this upside for Bitcoin, breaching new highs over the next 3 months, trading at 75K, 80K, something along the line of that. The complexity there isn't particularly expensive. So I think you have to be creative in macro. You have to look at odds, possibilities, look at what's priced in markets, probability distribution, option pricing, and see what you can bring on. And does that mean I'm a Bitcoin evangelist? No, not at all. It's an asset class like anyone else. You just need to be open-minded, I think.
It's starting to sound like a vol trader. I completely, now you're speaking my language. It's all about getting the distribution right. And as we've talked about, options are a much more efficient, optimizable way to express information. And to also, in a time of higher interest rates, capture that yield while still making your bets as well, which is, I think, an incredibly important point as well. If you do a historic analysis on volatility specifically, and the distribution specifically, not directions, how everybody thinks, and you do it for different asset classes, which we've done over that 15-year period, it is a dramatically different set of distributions for these asset classes. Never mind the direction. The distribution and the volatility for different asset classes are dramatically different. Most people may think that commodities, industrial commodities, had a very similar type of distribution to maybe gold during that time period. Not the case. They were almost polar opposite. Energy, and they both went top, to the right? Bottom left to top right. So people think, they're similar, but their personalities could not have been more different from a distribution perspective. Oil volatility actually got compressed during that time. Gold volatility exploded. And why? Because one is really more of a hallmark, as you mentioned, of the FX space and rates, right? And broadly inflation. And one is much more a function of supply and demand and economic growth. And what we saw is an underpinning of price that was a steady, consistent, controlled march higher with some shocks, but broadly a very smooth curve to oil. Whereas when we talk about gold, it was incredibly volatile, but significantly higher. And the best performing asset was gold, right? But in the context of significantly higher volatility. So I think that's important. Bonds, FX, gold, the dollar all had significant volatility during that time, but commodities, actually, ironically, equities, a lot of these things had very low relative volatility and actually lower as you get to longer time periods. So I think that's very important. And I think that allows for incredible opportunities. I've been saying for some time, gold vol is an incredible opportunity, not just being long of gold, which I think is important as well, but long gold with long dated calls. I think that is an incredibly optimal trade. And it can be funded by selling vol and other parts of the distribution in some of these other assets like equities and also in oil and other such industrial commodities. I think that's an interesting set of trades and opportunities, and not the way most people necessarily think about things, but where, like you said, if you're creative, there's significant opportunities. One thing we didn't touch on, which I think is important and that will drive this, is not just the pricing and those dynamics, but this people aren't talking about the Supreme Court decision here in the US, just to shift gears a little bit. It's not just the assassination attempt. That gives Trump significantly more power than the last time he was in power. Gives him the ability to really accomplish single-handedly, whether he has both sides of Congress or not, which he likely will, but really accomplish a lot of policies and exert a lot more influence than he did last time around. And I think that and the power politics that he, professes to and likely will try and deploy, similar to your initial point and your tweet that we talked about at the beginning of the show, will allow for a considerably more disconnect between the United States and emerging markets. It will allow the U.S. to export some of this inflation, to tax the rest of the world, even though this is a structural global phenomenon. And I think that itself will cause significant volatility. And this is basically the qualitative reason we had those quantitative outcomes in the 60s and 70s as well. That we will be able to, in the United States, export some of these problems through pure power politics. And I think Trump is willing to do that and will likely try his best to do that. Now, that will be volatile along the way. But I do think that makes for interesting macro trades and an incredible opportunity. And you don't necessarily have to get that trade right in the direction, but you can get it right in the form of the distribution and volatility.
Can I just, before you jump in here, because that's one thing I wanted to ask both of you, in a sense that we've talked a lot about Trump. Obviously, what happened this weekend makes it very likely that he will win and maybe win big. Of course, Jim, I have to remind you that in our year-end conversation last year, my outrageous prediction was that neither Trump nor Biden would be on the ballot, which oddly enough suddenly seems not completely unlikely for different reasons, of course. But what I really wanted to ask is, how does a Trump win? We've talked about the US economy a lot, but what about Europe? What about other parts of the world? You've just touched on emerging market, et cetera, but we're going to be dealing with something very different at a point where the global geopolitical, world is very fragile. So I'd love to hear your thoughts, and also in particular from you, Alf. I mean, we just had European elections. They're going in kind of a little bit different directions than what some had expected, and how you see that play out.
Well, in Europe, we can talk about the auto exporting thing because of the tariffs. But again, this is just an ancillary topic. The most important one is defense spending in Europe. Because basically, Europe acts as an ancillary to NATO and to the United States when it comes to defense, right? Military defense spending. And, Trump might have some different ideas about, how much and what is the role that the US wants to play with NATO and, foreign policy and all of that. So that is relevant because it affects fiscal and budgeting and that side of things over here in Europe. So I would say that is the most important thing to discuss, because first then the European policies on defense must change, the spending must change, and the fiscal impact will change as well. And the fiscal acts differently between Europe and the US, because the US is monetary sovereign and fiscal sovereign, and European countries are not. European countries are neither of the two, if you ask me. They are somehow fiscal sovereign, but to a certain extent, till Europe allows, basically, and they are not monetary sovereign per se. So that's quite an interesting thing. It's a bit like seeing the UK doing that, trying with Liz Truss that inflationary budget on top of an inflationary economy, and then having the bond vigilantes knock at the door and selling the pound and selling long end bonds, right? That's the emerging market bond vigilantes trade, where you sell your currency and you sell your bonds at the same time. And the US can afford a lot more there. The US is the reserve currency issuer of the world. So there is a structural demand for the dollar because of the euro-dollar system and how we have created the world around the dollar. The US can afford a lot more from that perspective, but places like Europe or the UK cannot. It's not the same thing. We have limitations by architecture, basically, and by not issuing the reserve currency of the world. And then on emerging markets, I think that if you are an emerging market highly relying on trade export and trade growth in general, you're not looking particularly good or to benefit from Trump policies. And if you are a country, you're lucky because you are Mexico or you're China in this case, then for idiosyncratic reasons, you're going to get a double whammy, right? So now, dollar Mexico, for example, is a trade that everybody is thinking about when they think about a Trump win. But again, dollar Mexico is negative carry, ladies and gentlemen. So what are you going to do about that? Question mark. Dollar China upside, oh, people love that because it's positive carry, right? I mean, the PBOC rates are below the Fed rates, also in the forwards and spot, so you don't pay to be in the trade. There, the problem is that the PBOC pretty much controls where the FX is. So basically, you can pay. In principle, it's the holy grail of the trade, right? It's positive carry, positive convexity. Everybody loves that, but let's talk about the positive convexity. I mean, the PBOC can make your life very complicated. They can devalue the currency, or they can choose to liquidate the enormous amount of FX reserves they sit on and make your life difficult, you know? So I think those trades are a bit harder to express as the Trump trade. They are clean in a podcast discussion. They're harder to express in a macro book. A bit like, I think the steepeners and importantly the upside options on gold and Bitcoin are the most interesting ones, I would say.
What are your thoughts, Jim?
Well, I think shifting gears maybe just slightly is the Fed, which is the part we've kind of not talked about. You mentioned it in your I mentioned the three-legged stool. You know, is the Fed going to change its personality? Is Trump going to take control of the Fed, and is it going to be less independent? That is a huge thing that people are kind of whispering about, but nobody's really betting on, talking about like a convex outcome and something that can really exert massive maximum pressure. You know, yeah, I think it's everything, right? And again, back to that Supreme Court decision, I think that allows Trump to do a lot of things that other people haven't been able to do in the past. And I think he's somebody who's willing to do things that are outside the box. I think if he wants to change Powell, he will. And I think given a mandate that he now has, I mean, I see Nixon as a analogy, right? Analogous. I think Trump is going to run, you know, you hear about Erdoganomics, right? I think there's a Trumponomics that's going to be akin, but scarier. It's with the power of the reserve currency of the world. And I think if he decides to run things incredibly hot, he can probably get away with it without some of the dramatic inflationary effects. I think it will be inflationary. But again, he'll essentially try and tax the rest of the world. I mean, if you look at his speeches, there's a famous one, I think it was in '88 with Oprah Winfrey. Like he's done exactly what he said then. You know, his number one focus and his zeitgeist is, hey, we're not charging the rest of the world. We are the most powerful country in the world. And yet we are seemingly at times, you know, benevolent. Like he wants to completely tax the rest of the world for the power of the empire. That's his zeitgeist. And I think the Federal Reserve allows him to, power of the Federal Reserve allows him to do that. And that is, I mean, that is a convex moment if I've ever heard one.
I think you're touching on, this is part of the property distribution, which I think it's poorly priced still. So the body of the move where Bloomberg is talking about the steepener because of the inflationary policies, fine, we discussed that. I think it's priced 50-60%. You can go and buy some of that remaining juice left if you think that it's going to win, it's going to sweep and all. But now we're talking different. Now we're talking tail risks, different story. So we are in a part of the distribution which is not priced at all. So there you should look at like dollar vol, long dated gold and Bitcoin vol, bond vol. So anything that basically has to price a probability that he's going to go and apply emerging market-like policies, because that's what we're discussing here, Jem. We're saying he's going to, President Lula, go and handpick who's going to be his new Fed chair. And this is what Lula is trying to do in Brazil right now by basically kicking out the current governor and trying to handpick a new one. And the market went like, oh, yeah, sure. So they priced a bunch of risk premium in the front end of the Brazilian rates curve, and they sold the Brazilian real aggressively for 9-10 sessions in a row. So you start getting that price reaction, but now you're talking US, not Brazil anymore. So you're talking something systematically important if you would choose to trigger one of these policies, right, that we discussed. And that's a different ball game. And the way to play it, I think, is, Neil, I see you there, Neil. So I'm just going to finish this with a joke, which is, I think Ray Dalio for the last 40 years has called for this bond vigilantes trade, which is like, you sell the dollar and you sell bonds at the same time and all that. And it's never happened. But now we are, I think, at a point where it's more reasonable to price that tail a little bit fatter. And the market isn't doing that. The market isn't doing that at all.
It's funny because I had it actually as one of my points. I mean, and you're kind of alluding to it, or maybe you're not. Maybe I'm misunderstanding it here. But I mean, I'm kind of thinking, should we start to take serious the idea that countries like the US could lose their AAA rating?
Oh, yeah, sure. Credit ratings are very political thing. I don't think it matters too much for the asset allocation thingy. From a regulatory standpoint, only when you get downgraded below AA minus for certain regulation, it makes it a little bit more punitive to hold your bonds rather than to own a AAA bond. But
So maybe let me interrupt you here. I think what I'm trying to say is that it's a little bit different. It's the whole understanding of what AAA means. It's the whole understanding of what the risk-free rate of return is. I think that's what I mean. That's what I worry about, that there's this, it's a little bit like, we haven't spoken much about Biden, but it's a little bit like what happened at the debate, right? Before the debate, people close to him, a lot of people in their own minds knew that there were some issues, there were some problems. But as Ben Hunt says, once everybody saw the debate, everybody knew that everybody knew, right? And it's that mindset shift that I'm thinking about, the whole risk-free rate of return.
Yeah, so sorry if I went into the credit regulatory side of things.
No, it's fine.
Now I understand the question. The answer is yes, we're talking about that tail risk specifically, Niels, here. We're talking about the fact that the US is the reserve currency of the world, and it's the most used collateral. T-bills are the most used collateral in any type of leverage transaction at any level. And the repo market in the US is the biggest in the world because we know the US policymakers normally play by certain rules. So first of all, they don't handpick their Fed member and they kick out the current one. And there is a rule of law and there is a bunch of stuff that we take for granted by now. And this is one of the reasons why we have managed to build a gigantic leverage system around the dollar and dollar collateral. That's why it works. Now you start shattering the foundations of that, and the story is very different. And as Cem was saying as well, Trump says that the US is sometimes benevolent with the rest of the world. Yes, guess what? This is how the system is supposed to work. If you issue the reserve currency of the world, ladies and gentlemen, you are supposed to issue these T-bills, this collateral, to provide dollar liquidity to the outside world when it's needed, because there are $12 trillion of foreign debt issued in dollars by countries that don't have access to the dollar, unless they have a liquidity swap line with the Fed and other sort of ways to get hands on the dollar. So Trump wants to, I think he doesn't want to necessarily shatter the foundations, but he risks doing that because, as Cem says, he's a power guy, he's a power play guy, and he might overstep. He might. Or maybe he might not. We don't know, but we're discussing here, what about these tails? Like, how are they priced? Like, what probability do they assign to Trump overstepping one of his policy agendas? And the answer is probability is close to zero. Like, if you look at the details of this type of stuff, honestly, like, we can make an assumption, like, as we speak, gold is hitting new highs, okay? New all-time highs once again as we speak. So where is gold supposed to trade if Trump oversteps on one of these policies and therefore shatters the foundation of the euro-dollar system, of the reserve currency status of the dollar? Well, you name it, ladies and gentlemen, but you look at the distribution of gold and you look at the right side and you say 2 standard deviation, 3 standard deviation. That's the type of area where you need to look at. And then you go and look at these long-dated call options and they give it to you like it's nothing. And so that's what we're talking about here. Again, it might mean you just waste your premium and you end up with nothing. That's still possible. But macro investing is about looking at odds and looking at the expected value of your trade versus what you think the odds are. And hopefully, sometimes you'll be better than the market in forecasting these odds, and therefore you'll make money. And I think here we're talking about underestimated tails, and what Cem has said is actually correct. The market is probably underestimating some of these tail Trump policies, let's say.
I think if anybody listening to this, walks away with one thing, is that it's not just about the probabilities, it's about the magnitude, right? It's about the distribution. And agreed, the probabilities may be priced in at this point, but the magnitude sure isn't. And those tail events you can bet on with much better consistent risk reward trades. And I think that really is critical to implementation of these trades. So I think well said, and I couldn't agree more. I do think last thing I'll say about this briefly is gold is interesting because where these tails are pricing, particularly shorter term, versus where the vol is pricing longer term, I think represents some opportunities. You were seeing significantly higher vol in let's say a January 3,000 call, versus let's say, or 3,100 call versus what you're seeing in a 270 or 280 call, in GLD out in, June or September. There are real opportunities to get duration, which I think is cheap relative to the tail and the short term. And I think that's particularly interesting. I will add to that I think the election odds, just to get a little bit more specific, the election odds and into the end of year vol odds that were there, right, because of past elections and all the things, now that there's certainty is still quite highly priced relative. Whereas if you think about Obama or Biden, right, they came in and passed massive policies. Now you have a Trump that not only has that mandate, who's likely to get a full power, he's somebody who really wants to exert policy and a change and a difference. And I think the vol in Q1 of next year is dramatically underpriced relative to some of that election and end of year vol, not just in gold, but across a lot of different asset classes. So something else to think about when we're talking about vol, magnitude, duration, distribution. These things are very important to get in some of these trades right.
As you were
Great stuff, guys. Yeah.
As you were speaking, Cem, I had to fire up my Bloomberg because last time I looked at the long-dated gold calls. So let's give some juice to people. So I looked at a 20-year distribution of gold returns. I took like 100 trading days. So let's say we're going to, somewhere like the end of the year type of expiry is something along the lines of that, okay? So it's like 100 trading days, 5 months, roughly, okay? Give or take. So around the end of the year, okay? So you look at these options now, let's say expiring 20th of December, 30th of December, and then a 2 standard deviation moving gold over the last 20 years where none of this craziness has happened apart from the crisis of 2008. We are never debated whether the US system could break, okay? So it's a very conservative 2 sigma event, let's say. It's 23%. So 23% moving gold during the time horizon could send gold to $3,000, which is pretty much what you're talking about, okay? So now, if you look at these options right now, the market implied the probability that you get in these. Let's say you want to cap your upside at some point and you say, look, I'm going to buy a call, I'm going to sell a call. I don't think gold goes to 5,000. I think I just want to play that part of the distribution. I don't care about buying the long-dated ball. I just want to cap it, okay? You get them, I'm not going to say for free, but almost for free. The upfront, the payoff in this thing can be 30 to 1, okay? Something along the lines of that. Now, does it mean gold is going to go to 3,000? Hard to say. Is there a chance that at some point during the process, the market says, oh, wait a second, I need to reprice the probability that gold goes to 3,000? Not that it go, but it can go, and it's not 3% anymore, it's 20%. Then you've basically made 7x your money. I'm very simplistic here, please, but just to understand what the philosophy should be around thinking around this event. So now we're discussing whether that tail is worth 3%, and we think it's probably worth a little bit more than 3%. So it's probability times the magnitude of the move. And here we think the probability of the body of the distribution is fairly priced. the probability of that type of magnitude move, so the tail specific part of the distribution, less so, we might want to argue.
Absolutely. Well, let me just add a little bit of a word of caution, as I should do, of course, and we're not here to give people investment advice, and they need to look into all of these things and risks themselves, but very good sometimes to visualize the things that we actually discuss, so I appreciate that. I think I'm going to leave it there. Hopefully, I assume we will have you back and continue our long-standing conversations, Alf, because it's always tremendous to have you on and hear your thoughts. And of course, to have this back and forth between you and Cem is always incredibly insightful. Of course, as always, people should go and follow you as well as Cem, because you have some wonderful insights. And since we are living in a truly global macro-driven world, it's really important to stay as well informed as possible. From Cem and me, thanks so much for listening. We look forward to being back as we continue our Global Macro series. And in the meantime, as usual, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.